A Black Rock executive was on the news the other day giving his 2 cents on why we are not heading into a recession. It's obviously a flat out lie, or he is the worst executive to ever work for BlackRock. Let's get right into it.
The bond market has gotten hammered and investors are fleeing in droves, but the selling pressure could also create opportunities. Joining me.
Real quick, what are bonds? I'm not an expert in finance, but I feel like it might be helpful since that is the main point of this conversation. Bonds are very similar to loans, but they are not given by financial institutions, they are given by individuals. They're like stocks except for they don't give ownership of the company. A rich person will basically give out an investment for a company. It's one of the main ways that companies are able to grow. And that's called a bond. Let's get right back into it.
Now, BlackRock Chief Investment Officer of Global Fixed Income, Rick Reeder. Rick, thanks so much for coming on the show. Really appreciate it.
Thanks, Jack. Thanks for having me.
So let's start with the Fed. They don't have a great track record of engineering that soft landing, but you're on the record saying you don't think we're headed for a recession. How does this scenario play out?
So listen, I think the Fed's in a tough spot. I think clearly they waited too long to start moving. It's actually ironic.
Too long to start moving is an understatement.
Like we're going to hear next week about the reduction of the balance sheet after just a couple of months ago, we were still putting money into the system. So it is a hard problem to solve. Listen, there are a series of things though that are promoting what is a pretty good backdrop for the economy today. Consumers in really good shape. You saw this from some of the data this week.
I'm not sure if consumers are in such good shape.
Consumers are sitting on $2.5 trillion of savings. You've got obviously income at very high levels. You've got a white hot jobs market, and corporates are in really good shape. So I think that economy, particularly look at what nominal GDP could look like when you've got this pricing power that companies have. Yes, I think they can avoid recession. Listen, the question is whether
that they can avoid. That's a key word.
Markets believe they can avoid recession. We won't know the answer.
The markets do not believe that. I don't know anybody that believes that. He's like, if you think it might be possible.
For a number of months, the question is the market going to get nervous about it, or already has gotten nervous about it certainly over the last few weeks.
Sure. So let's talk about two markets. We'll start with bonds and then pivot to stocks. So is it too simplistic to say, hey, look, we know there are rate hikes coming. That to me would suggest you really don't want to put money to work in bonds until at least the market sniffs out the end of that hiking cycle. But you know more about this than I do. What's your opinion?
I don't. So listen, I think the Fed's tightening financial conditions. They can't be any more clear. And
yeah, they could not be any more clear.
By the way, you could get a Fed that moves quicker, and we could hear in this next meeting that they could move quicker, i.e. 75 basis point moves in June and July, which, by the way, is not a bad way to do it when you think about to move quicker and then to be able to pivot if the economy slows, where you're seeing some parts of that today. So what do you do? Listen, I think the number one key to fixed income is you got to be patient, and
it's hard to be patient when you need money.
Where do you put money to work? I still think that you got to be conservative. You got to keep your interest rate exposure down. You're starting to get levels though that are getting really intriguing in places like things like investment grade credit in the U.S. and in Europe, where you're getting yields now that are well back of.
I guess just to add another 2 cents about what bonds are, because he was talking about the interest rates and be conservative. Don't just jump into it. When a rich person gives a bond to a company, they get paid back that money plus interest. That's one of the incentives for doing it. It's similar to how a loan would work also, where they get a little bit more back than what they gave you.
4% in some places, back at 5%. I still want to hear from the Fed and how fast they're going to go. But, start to put some money to work in some of the higher quality, particularly shorter on the yield curve assets are starting to make some sense and have some attractive break evens from a win versus lose perspective.
And to your credit, you went into this downturn with more cash than usual, so it sounds like you've got some dry powder. Let's pivot to stocks. Again, the market clearly is getting very worried. It's the longer duration stocks, the tech stocks that are getting hammered the hardest, understandable. What's your view of that market? How much farther does that have to fall before investors feel comfortable?
Please take his advice with a grain of salt. It's in his interest to make money on these companies. He may have bets against some of them, so just keep that in mind.
So I was saying, we were going through it in our strategy meetings today, both in the stock market and the bond market, and it's pretty hard to assess how far you are along. But my sense is that you are somewhere around 90% of the way there, both in bonds and stocks. Listen, I don't think 10-year treasuries are going to get much back of 3.25 type of yield. I mean, could they move a bit further back? They could. And then, the stock market, boy, you're getting the valuations. You were talking about some of the tech earnings, which, when you break it down, you look at the free cash flow generation of these companies today, i.e.,
Watch Taiwan, because if something pops off over there, these tech stocks may not be looking the same.
Pretty darn strong and still growing. And you talk about forward PE on some of these equities that are starting to get really attractive. So listen, I don't think we're that far away. We're starting to pick away a little bit. Where as you rightly mentioned, we're running maybe I think it's the highest level of cash we've ever run in our portfolios. But we're starting to pick away at some of these where the multiples have gotten pretty interesting today, including tech, including places that are structurally in good place, like agriculture, parts of the energy market, parts of the materials market. But
food, resources, materials. These are all basic common sense things.
I actually think tech you're getting in places. We're looking at software this week. Boy, you're getting companies are not going to reduce the amount they're going to spend on software. In fact, almost universally, they're talking about increasing it. Boy, the multiples now are getting pretty interesting. So we're picking away at it, but we're still saying pretty conservative.
Always be conservative when investing. And again, I am not a financial advisor. Do not take any of this advice from me. Don't take it from him. Don't take it from anybody. Do your own research and learn about this stuff. Don't just trust somebody blindly for anything. That is insane.
One thing I want to pick up, you mentioned energy, a very different trade from tech, of course. You think that still has farther to run?
I think the backbone of energy, yes, we've had quite a run, but I still think the backbone, you look at some of the refiners, we were looking at the forward cash flow dynamics around refiners over the next few years, because you're going to get obviously significant U.S. production. Those are interesting. I still think E&P has got a great backbone to it. It's hard to see real pressure on oil prices. Nat gas, well, you take the lost supply going into Europe and the lack of global supply of nat gas now, I think those markets are still well supported. And you've gotten, and by the way, the value, if you assume and you look at the forward curves on oil or nat gas, and then you try and then you bake in, gosh, what's the multiple off of those numbers? Energy's still in a reasonable place.
And unlike the past 10 years, those companies are showing some serious capital discipline. Rick Reeder, thank you so much.
That's right. Thanks for having me.
Very interesting. Do you think we're heading towards a recession? Put your thoughts into the comments. I would love to hear from you. I will always do my best to reply to everybody. If you're on YouTube, make sure you subscribe and hit that bell. If you're on TikTok, please follow. I love you all.